Welcome to Local Wealth Professionals YouTube channel again with our take on the 7 deadly sins of bank-issued mortgage insurance. This video is going to take about 6 or 7 minutes to help you understand everything you need to know about mortgage insurance. Please note our terms of disclaimer as usual. Remember that everything we offer you is for your entertainment and educational purposes only, and we suggest that you don't apply any of the principles that we tell you about without consulting first with a competent investment professional. Wow, you finally did it. You bought a house. That's great. So now you have to get the mortgage finalized. So you walk into the bank or mortgage broker's office, and when they say, "When you die, do you want to get this mortgage paid off?" you say, "Of course." The concept makes total sense. What might not make sense is how you go about doing it. So you have a mortgage. You want to do the right thing for your family. You want to save money too. So do you want mortgage insurance issued by the issuer, the mortgage issuer, or do you want term life insurance issued by a licensed insurance broker? Well, remember that when you go to buy that mortgage when you get the mortgage from the bank, you do not have to sign any extra documents. If they try to force you to buy insurance and they're too insistent, that would be referred to tied selling. In other words, if they tie your ability to get the mortgage on the fact that you buy the insurance from them, that would be illegal. And you need to only remind them of that and they'll back off. The document's there if you want to have a look at it. Okay, so let's get serious. What are these 7 deadly sins? Well, the number one deadly sin of mortgage insurance, buying mortgage insurance from the issuer, is post-claim underwriting. Post-claim underwriting really says that even though you're paying premiums, you're not necessarily covered. The insurance company will delve into your medical history when the claim is made. At death. That means that if you had any undisclosed health condition when you signed the papers, whether or not you or your doctor were aware of it, the claim could be denied. This is a big cost savings for the issuer because they save all the trouble of going through the underwriting up front. Also, everybody pays the same premium, which means there's no discounts for, say, having good health or being a non-smoker or being a woman who lives longer than a man. You might be paying for somebody else's state of health. With conventional life insurance, on the other hand, it is written at the time of issue, which means it's less convenient. It takes a little more time. You have to qualify. You have to answer some questions. You might have to do some medical tests. A nurse might come and take some samples to be tested, and it might take a few days. The process is less convenient, but once you qualify and the mortgage is underwritten, you have a unilateral contract with the insurance company which you sign, and there's no denying that you will be paid out, that your heirs will be paid out upon death. The premium reflects you. You won't be paying for somebody else's health conditions. Sin number 2, probably the next most heinous sin, is that the bank is the beneficiary of mortgage insurance as opposed to your family. This means that the death benefit goes to the bank, and you have no option but to let the mortgage be paid off by this type of policy. Sin number 3 closely follows that. It's the declining final benefit. When you took out that mortgage insurance in the first place, let's say your mortgage was $500,000. 5 years down the road, that mortgage might be worth $430,000 or $440,000, which would be $60,000 or $70,000 less. So if you died within that period of time, say right a month before the end of the 5th term, and it was $430,000 or $420,000, $440,000, whatever it is, that's what the bank would receive, because the other part would have been paid by you, but you paid a premium on $500,000 the whole time. Now, when you buy conventional life insurance, there's no declining final benefit. You buy $500,000 worth of insurance. If you die, the insurance policy pays out $500,000 at death with tax-free. And the bank does not receive the payout. The beneficiaries do. That means that they can decide how they're going to spend that money. Are they going to pay the mortgage down, or are they going to do something else? They've got some choices. Sin number 4 is portability, or lack thereof. When you have mortgage insurance, it's tied to the bank's mortgage, obviously, because the two are related, right? Which that means that if you need to protect that insurance because you think the insurance is a good deal, that means that you're beholden to the issuer of your mortgage, you have to renew with them. And as we all know, sometimes renewing with the existing insurance, with the existing mortgage issuer is not the best solution for you. It might be better to shop around. If you have a simple life insurance policy, which is portable, you can take it wherever you need to. You continue to pay the premiums regardless of whether you have a mortgage or not. And it means that you can shop around for the best mortgage deals when it comes time for renewal. And you don't have to worry about paying high premiums on the insurance. And that leads to SID number 5, which is when you get a new mortgage, you have to start again with a mortgage insurance. And guess what? If you did it 5 years ago, you're 5 years older now. When you're 5 years older, chances are that means your premiums are going up. And by the way, hopefully you're still in good health, because if you're not in good health, you might not even be insurable. And wouldn't that be awful? Now you can't get insurance at all. SID number 6, banks can't offer insurance needs analysis. Why? Because the person issuing the mortgage is not life insurance licensed. If you go to a life insurance licensed broker, they will likely offer you a needs analysis. So they're going to determine whether you actually need all that insurance or not. You may already have almost enough insurance, perhaps enough already, but if not almost enough, maybe you just need a little top-up policy, which might cost significantly less. As well, if you take your mortgage insurance, or the insurance that would be mortgage insurance, out with a broker, they can consolidate that with your car insurance and house insurance and maybe other forms of insurance. And you might get discounts on all the policies, which could give you savings right across the board. Finally, SIN number 7, lender-sold mortgage insurance is usually significantly more expensive than conventional term insurance. So remember, the first sin of mortgage life insurance is that it's underwritten after death. That is the worst part. Conventional life insurance policy is underwritten before death. It becomes a unilateral contract. If you die, it pays. That's it. Okay, let's look at some examples. Let's assume $500,000 worth of policy right across the board. 40-year-old couple, non-smokers, good health. Bank issues first to die, what amounts to first to die mortgage insurance policy, cost $2,203.20 based on a 2016 quote from one of the big 5 banks. The same bank went to their insurance broker, same bank, just a different unit, and the term policy for $500,000 with this under the same terms, $1,422, savings of $790.58 a year, or over $20,000 over the 25-year term. That's huge. Now, the insurance broker can also offer you another sweet idea, which is if both of the parties are in good health and they're 40 years old and they're non-smokers, what about having one policy each? Wonder how that's going to work out. Well, it works out really well, because you end up with $1 million of insurance, total cost $1,537. That's just a little over $100 more than the joint insurance policy you're going to have, but you've doubled the benefit. If one or the other dies, the other insurance policy will pay out $500,000, and it's still $666 cheaper than the bank issued mortgage insurance policy. So the conclusion here is clearly the last one is the best idea in terms of giving value for money. So maybe now that you got all this cool knowledge, ask your friends and relatives, do they have this type of insurance? Have they got the 2 policy thing going on? And have they already done this exercise? So what do you do then? Here's the last question. What do you do if you've got an existing mortgage and you already bought the bank's mortgage insurance? Well, you can go out and get a quote for term insurance. And if your premiums for your term insurance are going to be lower than the insurance that you've got with the bank, you simply get your insurance broker to issue you a slip to confirm that you've got mortgage. You go into the bank and show them to them, cancel the insurance policy that you had, the mortgage insurance policy you had with the bank, and carry on with the new term insurance policy that you created. If you want some more perspective on this, you can look up the CBC Marketplace investigative report on mortgage insurance on YouTube. You'll find it easily if you type it in. Meanwhile, spread the news and share this educational site with your friends and family. And if you need help, go to www.localwealthprofessionals.com, punch in your postal code, and it will connect you with a local wealth professional in your area. Also, if you're interested in the newsletter, you can apply for it also by going to www.localwealthprofessionals.com. Thanks very much for listening, and bye for now.